Alrighty, we're moving on to the next panel, and this panel was set up beautifully by the first panel as Duncan was talking about, how did he say it, a monitory democracy or a democratic monitoring, because this panel is all about transparency and the press, social media, etc. I do have a few housekeeping announcements. First, I just want to remind everyone that it's very important that you get to the microphones. There's one on either side if you want to have questions or comments, because we are recording this and we will be putting the entire conference up on YouTube so that people around the world will be able to see this. And that's important also for translation. The archives has asked us to remind you there's no food or drink in the auditorium. Those are their rules. Sorry about that. And I also wanted to note, since we were talking about the Lincoln assessment, that tonight at our reception in the Rotunda, where you will be up close and personal with the Declaration of Independence and our Bill of Rights and the Constitution and the Articles of Confederation, the archivists have pulled out from the archives and then made facsimiles of the actual documents, so we don't have the real ones, although they say there are real ones underlying it. The 16th Amendment, which was added to our Constitution to create our current income tax, the original 1040 form, and you can all look at that from 1913, because my favorite line on that form is the deduction for losses from shipwreck. Which tells you what was important in 1913 as opposed to today. Some Prohibition-era tax documents, which will be interesting, and then the Lincoln tax documents, his returns. So that will be interesting, and I don't think anybody's violating confidentiality, because I don't know that they had confidentiality at that time. All right, so we'll go into our second panel.
Thank you, Nina. Good morning. It's still morning, right? My name's David Bernori. I am the deputy publisher at Tax Analysts, and it is an honor and privilege to be here today. Before we begin, I want to thank Nina for organizing this wonderful event. For those of you outside the U.S., you should know that Nina Olson has done more to advance the cause of taxpayer rights than anybody in this country, certainly in recent years than anybody in this country. And I will tell you, as a citizen, I think that we're very lucky to have her in her current role. I really do. This session centers on the right to be informed, transparency in tax administration, and specifically, we're going to talk about the role of transparency in promoting voluntary compliance and trust in the tax administrator and the tax system. So it's kind of a continuation of what Chris's panel was talking about previously, which I thought was excellent. This happens to be a subject near and dear to my company, Tax Analysts' heart. We've been in business for 45 years now, Bob. And that's what we do. We are all about transparency. We are all about open government. And the founder of Tax Analysts and the current president say often that open government is good government and secret government is what dictatorships do. And we take that to heart in the tax world. We're going to start with Allison Christians, who's a professor of law at McGill University up in Montreal. She'll be followed by Lynn Oates, who is a professor of tax and accounting at the University of Exeter. And we'll then hear from my friend and colleague Robert Goulder, who serves as tax policy counsel at Tax Analysts. Then we'll hopefully open it up to your comments and discussion. So, Allison, you want to kick us off?
I sure do. Thank you very much. Thank you very much for that introduction. I have to echo the adoration of Nina. Let's be clear. So I want to tell you a story about taxpayer rights. I want to tell you a story about the taxpayer's right to know what the law requires of her and to have the law administered fairly. This is a true story based on things happening right now. I'm telling you this story instead of giving you a presentation on the law with a PowerPoint and statutes written out, because sometimes the law is too complicated and technical. It's even too complicated and technical for us tax lawyers to understand. Moreover, the law itself doesn't explain what isn't written on the books, which can sometimes matter more in terms of how things play out in practice. As you'll hear, the implementation of a law gives rise to a taxpayer's rights issue, one that wouldn't be clear from just reading the law alone. The story I'm going to tell you is about a woman named Tina. She's Canadian. She's 62. Tina is nearing retirement age. She's been a cautious and diligent person all her life, carefully saving for her old age, following the textbook investment advice we all know so clearly that tells us to invest in low-load, pooled investment vehicles, mutual funds, and hang on to them for the long term. Tina isn't buying and selling her portfolio. She doesn't have time for that. She has 2 kids and a husband. She lives in the family home she bought with him about 30 years ago. She's hanging in for slow and steady, reliable, low-risk growth, planning for retirement in Canada, our friendly neighbor to the north. As a younger person, Tina occasionally took trips down to the States. Visiting Florida in February, still a primary strategy and very tempting prospect given the harshness of Canadian winters, but Tina has only dreamed of that kind of vacation. She's very careful with her money. She plans to live on her savings. She doesn't want to burden her children. One day, Tina finds a letter in her mailbox. It's from her neighborhood bank where she's been banking for 30 years. She has all of her checkings and savings account at this bank. I want to read the letter to you. Dear Tina, in accordance with U.S. law, we have undertaken a review of our files and have discovered indicia that you were born in the United States. Accordingly, you must furnish us with the enclosed withholding certificate, Form W-8BEN, signed under penalty of perjury in the United States, indicating that you are not a U.S. person for U.S. tax purposes. In addition, you must furnish us with a certified copy of your Certificate of Loss of Nationality, your CLN. If you do not furnish us with these 2 items within 30 days, we must treat you as a U.S. person and your accounts as reportable accounts for U.S. tax purposes. If your accounts are reportable accounts, you must furnish us with a withholding certificate, Form W-9, indicating your status as a U.S. person, and you must provide us with your U.S. Social Security number. Any failure to provide us with your U.S. Social Security number when asked will result in a $100 fine. If you fail to comply with our documentation requests, we may be required to withhold tax for remittance to the IRS. Continued noncompliance will result in account closure, including cancellation of your mortgage. In accordance with U.S. law, we will furnish the following information with respect to reportable accounts to the Canada Revenue Agency, which in turn will furnish this information to the U.S. Internal Revenue Service. Your name, your address, your U.S. Social Security number, your Canadian Social Insurance number, your account numbers, the name and information of any person sharing your accounts, the highest amount in your accounts any time during the year, and any gross amounts paid into your accounts during the year. Thank you for your attention to this matter. Your bank. Tina reads this letter through a few times and tries to understand it. Withholding certificate, certificate of loss of nationality, U.S. person, reportable account, fine, account closure, mortgage cancellation. Yes, she says to herself, it's true. I happen to have been born in the United States, but it was while my Canadian parents were on exchange as students. I'm not really American. I don't have a Social Security number. I never voted for president. I don't have a passport. I've only ever been there on vacation. This can't be for me, right? If it had come as an email, Tina thought it might be a phishing attempt, and she should forward it to someone. Concerned, Tina calls her bank. Her bank's employees are all very nice in that friendly Canadian way. Sorry, but the rule is if you're born in the US, you have to prove evidence to the contrary, or we have to treat you as a US person. One clerk takes pity on Tina. Look, I know this is crazy, and it's catching everyone by surprise. You're not alone in this, but you need to talk to somebody who knows something about US tax law. Maybe find a US accountant? Tina goes home and talks with her husband, a Canadian since birth. He doesn't think it sounds right. How can the US be after you? You're not really American. How can Canada give your information to the US? You're Canadian. After shaking his head a moment, he realizes, hey, those are my accounts too. I don't have anything to do with the US. Why do they get my information when that's no business, they have no business knowing it? Tina and her husband decide to ask around. Tina calls one of her kids, who's just as clueless, but promises to do a little digging. A trip down the Google rabbit hole, quite alarming. The message boards and blogs are buzzing with horror stories about something called OVDP and compliance and CLNs and fines and penalties and interest, and how the US is on a global hunt to find all of its hidden citizens using foreign accounts after Congress passed this law called FATCA. Fat cat? No. FATCA. A few years ago to crack down on tax evaders, but now ordinary people are getting hit with massive fines and losing access to their life savings. Tina and her family are scared. They know they're not tax evaders, but they don't know what to do. Tina doesn't know what to do about that W-8. She doesn't have a CLN or any idea how to get one. She and her husband don't even know where to start. Is Tina really a US person? Even though she never got a social security number, never applied for a passport, never earned income in the US, never spent time in the US except as a tourist as a kid? The blogs say she could be in big trouble. Tina decides she has to put her mind at ease by speaking to an accountant with US tax expertise. Surely they'll just clear this up. Tina learns from the accountant that unless she has renounced or relinquished her US citizenship, she's a US person and she needs to provide her bank the information it wants. And they're going to send her information to the IRS. But it's not just tax forms the IRS wants. They also want this report called an FBAR, a foreign bank account report. And there are multiple penalties associated with any failure to make any of the required filings. Tina doesn't think she's relinquished or renounced her citizenship, but she wonders if maybe she could do so now. After all, she's not really American by any stretch of the imagination. The accountant says, unfortunately, you can't renounce until you go back 5 years and undertake compliance, 5 years, and then you have to pay a fee. So no matter what, Tina, the Canadian, finds herself considered American. And she's going to have to get compliant. She's one of many such accidental or incidental Americans, many of whom live in Canada. But it's of no matter how she acquired US person status or had it foisted upon her. Only once she's compliant with US laws, to which she never knew she was subject, can her accountant help her renounce her status. But renouncement not going to come cheap. When Congress passed FATCA, it noticed more people renouncing their citizenship. And so in an effort to discourage this, they recently hiked the fee to $2,350 to be allowed to leave. Of course, this amount is on top of all the paperwork involved to leave, and a lot of paperwork can bring more tax to pay. Tina's overwhelmed. She says she'll cross that renunciation bridge when she comes to it, but in the meantime, she has to comply with the law to avoid anything terrible happening. The accountant reassures Tina there are a lot of people in her situation, suddenly discovering they're American, and have tax obligations in a country they don't call home. Unfortunately, finding out she has U.S. tax obligations is only the start of things for Tina. When she starts to discover all they entail, she's in for an absolute tailspin. Because Tina hasn't planned her life with U.S. law in mind. It turns out all those low-load pooled investment vehicles, mutual funds, there's something called PFICs. The accountant explains that the rule for PFICs, passive foreign investment companies, was passed to stop rich Americans from holding their investment portfolios through companies in tax havens, thereby avoiding U.S. tax obligations. But PFICs rules don't distinguish between tax havens and places like Canada, which also taxes these kinds of investment vehicles. Since none of Tina's investment savings are in the United States, the accountant tells her that probably all of her mutual funds are going to fall under the rules for PFICs. The bad news is that the PFIC regime is designed to be so harsh that no one would ever own one. It's a deterrent. The only way you would own one is if you were treating it as a partnership, making it mark to market on an annual basis. Since Tina didn't do that, she's going to be subject to this harsh tax treatment, which in effect means going back over the entire holding period of each mutual fund, calculating U.S. tax at the highest U.S. tax rate in effect in the year in question, and calculating an interest charge for the delayed payment of that tax for each year, and then compounding the interest forward to today. The accountant explains that this all but wipes out her return on the investment. That's what PFIC's designed to do. He then explains that selling won't help, and in fact makes it worse, because the gain on the sale will also trigger Canadian tax, and this tax under the PFIC rules is not creditable against the U.S. tax. In effect, she's looking at a combined tax rate on her retirement nest egg of a conservative 70%, with 100% not an unreasonable estimate, and possibly even eating into principal. And all of this is the case even though Tina would otherwise be in the lowest marginal tax bracket, or not even make enough income to have to file taxes at all in the first place. The accountant notes as an aside that Tina's family home may also generate some tax liability in the future, since in the US some gains from the sale of your principal home are taxable. That is too worrisome to think about, so Tina puts that thought aside for later. I think you could understand why Tina might be more than a little overwhelmed at this point in the story. And that's even before I tell you that the accountant is going to charge her $15,000 to $20,000 just to get her compliant. And that if she had known any of these issues in advance, she surely would have made some different choices over the years. One of those choices would have been to avoid certain kinds of pooled investment vehicles, or at least undertake mark-to-market accounting to avoid the interest charges. Another would have been to put all of her assets in her non-US spouse's name. That's right, Tina would have been advised to divest of all of her assets. This is real advice that real American women are getting from real accountants right now all over the world. I'm not really quite sure what policy goals that serves, but let's leave that alone for now. In any event, Tina did not know any of this, and no one told her anything until she found out from her bank teller, some blogs, and an accountant in Canada that she's now at risk of losing her retirement savings because of a country she stepped foot in only a handful of times. Tina doesn't know where to find information that she needs, and the stories about the IRS imposing monstrous penalties on others who went through offshore voluntary disclosure are terrifying. I would venture to guess that no one in this room and no one watching this later thinks this is a good outcome from a policy perspective, even if all the rules that I've described were adopted for good reasons. All this brings me back to the subject of this conference, taxpayer rights. What is fair for a taxpayer to expect from a government that seeks to tax her? And what can and should tax administrators do to make things okay for the thousands upon thousands of Tinas that are living through some version of this scenario right now. First, regarding what a taxpayer has a right to expect from a government that seeks to tax her. I think a taxpayer has a right to learn that a government seeks to tax her from that government itself, and not from a bank employee in another country with no U.S. legal knowledge or expertise, and certainly not from blogs written by those who understandably feel hard done by this situation, or, possibly worse, those who stand to gain by charging for compliance, very expensive tax compliance. My idea is, if that kind of information flow is hard or impossible for a government to deliver to its own taxpayer population, then that government should not be imposing such an impossible situation on an individual to begin with. Related to that point, I think a taxpayer has a right to learn that her whole financial life is subject to harsh deterrence and penalties solely for the reason that it is not located in the United States, even and especially when she is not located in the United States. I think she has the right to learn that not from blogs or word of mouth, but from the government that seeks to impose these rules on her. I think she's got a right to be informed about a life-destroying force like PFIC by the government that seeks to unleash that force upon her, and a right to avoid that punishment by making different choices. And if a government can't or won't bother to inform her or address the utter absurdity of stripping a person of their life savings as a consequence of inadequate form filing, I think she's got a reason to complain that this is a pretty unfair administration of a very complex tax law, a law designed for millionaires with expensive tax accountants and not for Canadians carefully saving for their retirement and not hiding anything from anyone. In my remaining time, which I know is growing short, I want to quickly cover 3 things I believe Treasury and or state could do today to address the ongoing trauma, what Joe called catastrophic failure in the last panel, that's being unleashed on U.S. persons in Canada and elsewhere, all over the world, right now. The first has to do with the PFIC regime. The PFIC regime results in, at minimum, a clear instance of double taxation. And my idea is that it can and ought to be fixed right away. It could be fixed by a general agreement between U.S. competent authority and the competent authority of its treaty partners. Obviously, that includes Canada, but many other countries as well. Article 20, as an example, Article 24 and 26 of the Canadian-U.S. Tax Treaty gives the competent authorities the ability to enter into agreements consulting together for the elimination of double taxation in cases not provided by for the convention. There are plenty of precedents for competent authority agreements. We do them all the time for transfer pricing. If we can do it for multinationals, can we not do it for individuals? The second has to do with high tax countries. Canada is a high tax country, and most non-resident U.S. persons live in high tax countries. For these people, most U.S. tax results from timing differences in which the tax actually belongs to the source country, which is to say the country where the U.S. person actually lives. It is therefore safe to exempt most, if not all, local accounts and savings from reporting and tax consequences altogether. Enacted as a same country exception as I suggested 4 years ago, or again make it treaty-based relief of double taxation if you're worried about abuse. But this does 2 things. It eliminates pointless administrative costs on both the IRS and the taxpayer. It encourages compliance with U.S. tax law more generally because compliance goes from virtually impossible and absolutely terrifying to basically manageable for everyone, with virtually no change in revenue generation in the long run. The IRS can use the saved resources to focus on the targets FATCA was intended to focus on, namely people who are trying to hide money in offshore accounts, not retirees with their names and information clearly associated with lifelong savings accounts in high-tax countries. Lastly, if none of the above are possible, Treasury and State have got to find a way to allow people like Tina to make a free exit from the United States. I think this is a drastic situation and a worst-case scenario. And in my view, it would be best to be avoided because it's so unnecessary. I'd rather not see it. But to be clear, I'm not talking about exit taxes, taxes that apply mostly to very rich people. No, I'm talking about the whole cost of getting into the system in order to be allowed out, only to be socked in the gut with a $2,350 fee to be allowed to leave. I think the place to start is repealing that renunciation fee. I believe this fee violates another individual right, namely the right to change one's nationality, which is enshrined in US law. I expect litigation to restore that right will eventually wipe away the renunciation fee altogether. But in the meantime, it should at least be possible to remove it for the Tinas of the world. That fee was imposed administratively, and it can be revised the same way. Relatedly, the hoops and hurdles for streamlined compliance and other administrative action can and should be tailored to accommodate cost and penalty-free, but most importantly, do-it-yourself possible compliance and exit for people like Tina. If we don't cut out the compliance industry, I don't know if we're going to be able to see change. My story's gone on too long, and I apologize to my panel, but I hope I have at least highlighted how in the United States the issue of taxpayer rights is a global issue. If we believe the words of the Taxpayer Bill of Rights have any meaning at all, then we must agree that the Tinas around the world have a right to expect the US to do a little better by them. Tina's case is not one in a million. It's one of millions. Millions of individuals abroad adversely and unfairly affected by US tax law. We can do better, and the Taxpayer Bill of Rights says we must do better. Thank you very much.
Thank you, Allison. Allison, what happened to Tina?
Well, I cut off the end because there's not enough time, but the end would have said there's no happy ending for Tina.
There's no happy ending for Tina?
There's no way out.
She's not going to sneak across the border, is she, and become a... Oh, never mind. That's a whole different story. Lynn, you're up.
Thank you.
I find myself the only speaker with a PowerPoint presentation. It's a function of working in a business school where it's an expectation. Spacebar. How do I get there? Thank you. I'm going to abuse my privilege a little bit and just say a few words about where I come from. So I work at the University of Exeter, which is a small city in the southwest of the UK. I'm also Deputy Director of the Tax Administration Research Centre, which is a fairly recent creation. It's jointly funded by HMRC and also an academic research council in the UK. So we're an independent of HMRC, but we're doing work funded by them. And I'm also managing editor of a new journal, which I'm happy to talk to anyone about over the course of this conference. The point of connection between my presentation and Alison's is really the social media aspect of it, where Tina's, was it her son, went looking for information in the interweb and found loads of stuff. And I want to talk a little bit about that. I want to draw on some recent UK experience and to reflect on modern society, and particularly the relationship between social media and tax. And it's important to understand the context in the UK, because the past 3 to 5 years has seen unprecedented attention being paid to tax. Before then, tax was largely invisible. People didn't talk about it. It wasn't something people talked about. Friends and colleagues' eyes would just glaze over when they found out what I did for a living. And then suddenly, about 5 years ago, everything became interesting. We had news stories with parliamentary inquiries. You've got the rise of tax activism, and these have all contributed to a widespread interest in tax and tax compliance. And we've got new vocabularies being introduced, new words and phrases being used in popular discourse that weren't used before: tax dodging, bending the rules, spirit of the law, whatever that is. And students are now queuing up to do tax courses, which is great for me. And colleagues actually ask me questions now about tax, which is also great. And what's interesting is that everyone now has an opinion about tax. Not always well-informed opinion, but an opinion nonetheless. And people who had never previously discussed tax are now doing so, and more than willing to share their views to all and sundry through social media. So it's not something that's, it's no longer something that's ignored or only spoken about down the pub or something. And most of you will be familiar with the happenings in the UK in relation to large multinationals. So you'll be aware of the heat that has been generated over Amazon, Google, Starbucks, where the very Public Accounts Committee has famously called representatives of those companies to give evidence. But there's a few other stories that I want to share with you as a precursor to a discussion about social media. And the phrase cozy deals first started to be used in about 2010 when Vodafone was reported as having settled a long-running dispute with HMRC, and there's a bit of confusion about the amount involved. The media suggested it was a very large figure which could be used to fund schools and hospitals and housing and so on. And an HMRC spokesman confirmed that the liability was 1.25 billion, and saying that the other figure was an urban myth. And this was really the beginning of a sort of publicity around cozy deals, or sweetheart deals, as they're sometimes called. 2011 saw Goldman Sachs coming into the spotlight following a HMRC whistleblower's revelations that there'd been an agreement to forgive an interest charge. And this quickly moved into the realm of the Public Accounts Committee, because Mrs. Hodge is particularly partial to whistleblowers, and a variety of people were brought before the committee. The quote I've had there is from UK Uncut, which I'll come back to in a minute. But subsequently, the National Audit Office in the UK did an inquiry on these cozy deals, 5 of them they looked at, and concluded that the settlements reached were reasonable, and they actually presented value for money for the taxpayer, although there was some criticism of HMRC in relation to the process. Then in 2012, to keep up the momentum, putting the pressure on this publicity around tax dodging, or whatever we want to call it, the spotlight shifted to a few celebrities, one of which was a comedian, a UK comedian called Jimmy Carr, who had participated in a tax avoidance scheme called K2. And it involves sheltering income from UK tax using an offshore vehicle. And Carr publicly apologised for having been revealed, having been involved with this thing. And he said, he actually apologised via Twitter. And he said, I met with a financial advisor, and he said to me, "Do you want to pay less tax? It's totally legal." I said yes. I now realise I've made a terrible error of judgment and will in future conduct my financial affairs with much more responsibility. Apologies to everybody. And he disappeared from the TV a little bit for a little while, but then slowly came back. So what was the public reaction to all of this? The public reacts. I go back to UK Uncut, which started life, it's made up of the people who take part in actions. We are ordinary people, we are you. And they started with a load of blockades of Vodafone shops around the UK in 2010. The website of UK Uncut says that there's subsequently been about 800 protests. There's lots of people standing around with placards accusing Vodafone and other people of tax dodging or not paying their fair share of taxes. And importantly, UK Uncut not only staged these protests but also took legal action in relation to the Goldman Sachs case that I referred to earlier. And although they were ultimately unsuccessful, the very fact that they were able to proceed is testament to the sort of power of social movements in our modern world. And we've also got the Occupy movement, which takes as its focus a much wider remit than tax, but tax is in there as part of it. And this started outside the London Stock Exchange in 2011. The Occupy movement and UK Uncut both rely very much on social media to bring people together. Occupy in particular, I'm very proud to say in Exeter we had 13 tents outside of the Exeter Cathedral for a short period of time. But Occupy movements brought together really large numbers of people who may not have been previously politically active, and it's using social media to extend the realm of activism. And it's the rapid diffusion of comment and opinion in relation to each of these stories that was largely facilitated by social media. Now, I can't pretend to be an expert on social media, I have to make that very clear, but I am an observer of social media. And I think it's fair to say that social media, so Twitter, Facebook, blogs, various things I probably don't even know about, are dramatically changing relationships between individuals in society, but also between individuals and society as a whole. And social media is creating new identities and new causes. And importantly, users of social media generate a substantial amount of unverified information that cannot be managed. And we have to really bear that in mind. It has this capacity, social media has this capacity to create a collective truth about all sorts of things, including specific organisations and individuals. So, admittedly, a story about a tax-dodging comedian is not likely to grab the public imagination in quite the same way as a story about an angry feline, but it does. There's no question, though, that it's capable of very rapid diffusion of information, and it creates very real reputation risks. And these reputation risks are not just for taxpayers, but they're also for tax administrations as well. And it's this collective truth-making that social media, truth in inverted commas, that social media facilitates that makes it such a powerful tool for social protests. So, as I said, social media is quite capable of bringing together diverse groups of people whose paths may not have otherwise crossed. So we're seeing a new dynamics of activism, and we're seeing public opinion being expressed in very public ways. But I would just want to pause for a minute and think about what exactly is public opinion. And to what extent do the views expressed in the social media represent majority views? And I don't want to alarm anyone in the room unnecessarily, but did you know that not all journalists or non-government organisations or activists are principled and objective? I'm sure that everyone in this room is principled and objective, but in the wide world, there are some out there who are not assiduous in their fact-finding and very quickly jump on what appears to be a headline-grabbing story, but actually probably shouldn't be. And in the hands of social media, misinformation spreads extremely rapidly, and especially when numbers are used. What is it about attributing numbers to things? It's because numbers are scientific, I guess. And there is this phenomenon identified in a strand of scholarship in mass communication studies called the spiral of silence, which I thought was quite interesting. And it points to the way in which we, as social people, as social actors, on the whole, we don't want to be one of the minority. And people, we are less and less likely to express a view or an opinion if we believe we are in a minority. And so the voice of the majority becomes progressively stronger in the absence of challenge until you end up with something that is called public opinion. But sometimes we might want to ask whether it really is public opinion. So what are all the implications of this for tax morale, which is another part of the title of my presentation? We've moved a long way, well, most of us have moved a long way, from thinking about tax paying as something done by Homo economicus, and that reducing compliance decisions to some sort of cognitive function of weighing out what are my chances of getting caught, what are the penalties I'm going to have to pay. And we know that's no longer adequate as an explanation for taxpayer compliance. And we know that there are other non-rational forces at work, and the research by Eric, which we'll hear about later, and colleagues in Vienna and many others have helped us to expand our vision of tax compliance as more than just a reaction to audit rates and penalties. And we now talk of tax morale, we talk of social norms, motivational postures, social influence. Actually, we still don't know much about tax morale. We're still figuring this out. And particularly, we don't know much about how stated attitudes translate into actual compliance behaviour. But there's a lot of research being done on taxpayer compliance, and much of it is based on self-reported data, so filling in questionnaires or putting people in laboratories and doing experiments. And we've been doing some work at the Tax Administration Research Centre, we decided to look at naturally occurring data to try and get some more insights into tax compliance. And so what better place to look than social media? And social media has the capacity to make things visible. And we think by looking at social media sources, we're able to kind of shine a light on something that's normally quite murky, which is how taxpayers talk amongst themselves about their tax-paying obligations. One of the studies we did, and I must say this was not a TARC-funded study, this was just a separate piece of work, but we looked at the reactions to the Jimmy Carr story. We looked at comments that people were posting on newspaper websites around the stories, and we also looked at some Twitter feeds as well and did a bit of a thematic analysis to see how people were discussing this revelation that Jimmy Carr had been involved in a tax avoidance scheme. And I'll quote you some of the things we found. Jimmy Carr, tax avoidance scheme, he's a hypocrite, and that's official. Shame on him. There were some people who were kind of almost admiring, I guess. Jimmy Carr has done what most property tycoons, MPs, entrepreneurs, and most business people do to avoid tax. Or another one, I think you're a genius, and that's without the apostrophe, which is a bit shocking. I think you're a genius for using K2 scheme haters are just jealous that you have the brains they didn't. So a variety of responses to this. But we found that tax avoidance was being discussed as an issue of right or wrong, and the most frequently stated view that Jimmy Carr should pay back what he'd avoided. And there was also discussion about it as an issue of fairness, particularly in relation to the gap between the wealthy and the others. So tax avoidance is being discussed as something the wealthy do. But also a political issue. There was a number of discussions going on blaming politicians for tax avoidance and expressing a lack of trust in politicians. So the analysis suggests that public debates about tax avoidance are contributing to an increasing divide between different groups in society, as well as disillusionment with politicians. Another study we did, and this is a TARC-funded study, involved analysing online discussions of people talking about tax. We looked in particular at some occupational forums where people in particular occupational groups gather together in cyberspace and discuss things relating to what they do. And we trawled through this to find out how they talk about tax in this space. And part of what we did was look at what happens when novice, new people to this occupational group go in looking for advice about what to do. Let me just give you an example. So user 1 says, am I supposed to be paying tax from my freelance design services? I'm not at the moment, LOL, in small letters. User 2 says, you need to register as self-employed or HMRC will take you to the cleaners, LOL, in capital letters, exclamation mark. User 3 comes in and says, broadcasting on a public forum isn't the smartest idea. HMRC have access to the internet too, you know. And this goes on for a while. There's a few other people involved. And then user 1, our initiator, comes back and says, thanks for the helpful stuff, guys. There's no chance of them finding me. Andrew isn't even my real name. They know nothing about me. And then user 3 comes back in and says, it doesn't matter what your name is. If you're not paying tax, as you previously admitted, then it's only a matter of time before they find you and recover what's owed. And user 1 comes back sometime later and says, you have to declare in the first 3 months. I'm now paying tax. But in our study we found, so we looked at a whole range of these different conversations, and we found quite a lot of statements, very normative statements. So people responding to other people's inquiries with must or should. Yes, for example, do I really have to pay tax on this income? And someone else comes in and says, doing business is good and paying tax is part of doing business. Seems simple enough. And then another one, but I don't want to pay it, sad face. And then someone comes back and says, well, paying tax is paying part of life. You can't get away from it. We find evidence of some users accusing the novice of transgression, and this is usually met by very defensive statements. So someone says here, looks like you're looking for ways to evade your taxes, and the novice comes back and says, I'm honestly not trying to evade, I just don't know much about taxes. And we also found evidence of positive reinforcement. So these are taxpayers talking amongst themselves. So here's one. I've just sold my first website and I believe I now have to pay taxes. I would really appreciate some advice. And then someone comes back and says, it's not often that you'll find a 17-year-old asking for advice on how to pay taxes. I respect that a lot. And then another response to our guy who says, but I don't want to pay it, sad face, was some helpful advice. Then you can make sure you claim all your allowable expenses and take advantage of legitimate tax savings. There was probably a tax advisor responding to that one. Other respondents went in for a more direct approach. Do yourself a favour, do things the correct and legal way. You'll be glad you did. And there's also some warnings and threats. This is one of my favourites. You should never in capital letters, which I understand is very rude. Yes. Okay, you should never mess around with the tax man. He will have your hide for his boots and leave your carcass out in the sun for the vultures. I assume that wasn't a British commentator. Interestingly, we only found one comment in our whole data set about audit probability, and someone did helpfully say, statistically, the possibility of being audited is about 1%. Get the hint? Question mark. But overall, our conclusion from this analysis is that compliance decisions are really complex. It's not a binary thing. Do I comply? Do I not comply? And there's a whole load of people involved, a whole lot of actors playing a role, and it's not just the taxpayer, the tax authority, and professional advisors. It's friends, real and virtual, and also occupational peers as well. A whole load of people involved in this. And we do find that taxpayers seldom discuss audit probabilities and so on, and that social influence is really important. So what does this mean for tax administrations? Well, it means there's amongst tax administrations there's growing interest in the opportunities and threats that social media provides. So it gives opportunities to gather all sorts of data, and it's the opportunity to gather information about what taxpayers are having trouble understanding. So our conclusion from our research is that people are not on the whole trying not to pay tax. They just want to pay it, but they don't understand how to go about it. They don't know how to get the information they need, like Tina, although that's fairly extreme, but it's the same phenomenon. And so it is an important source of information, but it does have threats attached to it. So with the use of social media by tax authorities, you've got security issues around participating in social media. I wonder if some of the responses to some of the comments I was talking about earlier were actually planted by tax authorities. I don't know. But also it has the potential for eliciting negative feedback about the tax authority and undermining the public perception of the tax authority. Nudging. I won't talk about nudging. I'll talk to anyone about nudging at some other time, but my fundamental position is that I'm deeply suspicious of nudging, but it seems to be very popular in the UK. So in conclusion then, social media is transforming how we learn about things and how we form opinions. And on one level, social media and its influence is beyond our control because it's so fast, very fast, and it's entirely unpredictable as well. And tax administrations need to harness social media as best they can, but in the knowledge that it can't be controlled, and it can be an opportunity to foster compliance and possibly boost tax morale. But on the other hand, the spread of misinformation can lead to reduced morale. So there's my link between social media and morale. The bottom line is that we don't know much about the impact of social media on tax morale. And importantly, it's likely to be culturally or contingent. So it's going to play out differently in different countries. We need to be a bit careful about looking at what happens in one country and transferring those ideas to another, because tax is very culturally and historically contingent. And it does have implications for questions of transparency. So transparency isn't necessarily a panacea, And the capacity for social media to distort information shouldn't be underestimated. Certainly for a tax authority, it's a double-edged sword. So it's this opportunity to foster compliance, but the spread of information can reduce tax morale. Certainly there's more work that we need to do to understand these forces, and we're always lagging behind social developments in tax. We have been throughout time. And certainly it means that for those of us doing research on these issues, our jobs are safe. Thank you.
Thank you, Lynn. Lynn, two questions. Is nudging a British thing?
No. It's
Okay.
American.
And is Jimmy Carr funny?
I think so.
You think so?
I think so.
All right.
Many other people share my view.
Okay.
Yeah.
Robert, you're up.
Well, I'm not sure whether I've been nudging or not all these years on social media. If I have and it's inappropriate, I apologize. If I haven't been, somebody please explain to me how to do so, and I'll be working on that in the near future. As David said at the outset, I work for Tax Analysts, which means I get to wear two hats. And a lot of people in our organization do. I'm a tax attorney as well as a journalist, and we have people who are CPAs as well as journalists, or maybe someone has a PhD in economics and they're a journalist, or a historian and a journalist. And that's, I think, makes us a unique organization. I sometimes have to explain that when I travel abroad, because I'll meet people from other countries, and they don't necessarily have this concept of a tax press where they live. And one of the themes that hopefully will come across from the discussion today is that a tax press is a good thing to have. It can be sort of more formalistic the way we do it with actual publications, or I suppose you could take a more expansive concept of what the tax press is, getting into things like social media and so forth. But what I'm going to be focusing on are some of the trends that I've been seeing recently in the tax press and what they mean in relations to the Taxpayer Bill of Rights, and particularly the first item on it, Article 1, the right to be informed, something we take very seriously. In fact, in my office, Nina will like this, I actually have a plaque of the Taxpayer Bill of Rights. I had it mounted, and it's displayed in a position of prominence. I see it every morning when I walk into my office. If somebody comes in for a meeting, it'll be the first thing that they see. I want to thank everyone at the Office of the National Taxpayer Advocate who had any role in disseminating that, because I think it's something that needs to sink in people's minds, especially the policymakers who are making key decisions that affect our rights. So how well are we doing collectively as a tax system in terms of living up to this lofty standard of the right to be informed? So hopefully that's what we'll get at today. To start with, I wanted to just rack your brains a little bit here. We talk about taxation. Taxation follows trade. So where commerce goes, taxes will surely follow. A quick example of that, 25 years ago, nobody would have guessed that policymakers would ever be sitting down trying to figure out ways to tax e-commerce, because 25 years ago, nobody knew what the internet was, or that it would someday influence global consumption trends in the stream of commerce. 10 years ago, I suspect not many people would have thought that policymakers at both the state, federal, and international level would ever be sitting down at symposiums swapping ideas about how to tax the cloud. Yet today there are entire seminars on that very issue. This makes me wonder what's next. What topics will taxpayers and tax administrators be hosting symposiums and conferences about 10 years from now? And hopefully we'll be having conferences about international taxpayer rights 10 years from now, so maybe we can have some foreshadowing. My guess is bitcoins. I suspect fortunes will be made and lost in bitcoins, and that some form of tax arbitrage is probably inevitable. I was talking to somebody just the other day who was in a JT program and taking some tax courses, and they wanted to know what area of the tax law they should specialize in. And I thought, be at the front end of this wave of tax arbitrage based on bitcoins. So we'll see. And actually, Tax Notes International has already published a cover story on the taxation of Bitcoin. So it helps to be ahead of the curve. Still, it's not always easy reporting on tax, and we've noticed some disturbing trends that I wanted to talk about. And let's get to those. The first adverse trend that I'm seeing is that a lot of government officials are increasingly being asked to speak at events that are closed to the press. Now, I'm not suggesting they necessarily do speak at those events, but they're being invited to do so. And that, in and of itself, is something I have a problem with. Earlier this year, this is an actual anecdote, over the summer, a Tax Notes reporter was kicked off of a webcast at which a state revenue commissioner was speaking. Now, the webcast in question was sponsored by a law firm. They had some assistance from an outside web hosting company. And the attempt by our reporter to sign in and attend virtually, like any other member of the public, it was met with a screen saying that the person's online session had been terminated. Well, it's never good to be terminated. That was not a software glitch or something that you can blame on a program. The reporter's exclusion was intentional. The people in control of that event did not want the media listening in. They decided that certain issues of the tax law were going to be discussed and that these were sensitive issues, sensitive areas of the tax law. And the determination was made that having the media present would have a chilling effect on the degree of candor that the participants would otherwise have. And the participants were attorneys representing private clients, as well as a state tax commissioner. So what critical things did the state tax commissioner say? The public will never know because we, the media, will never know. Bear in mind, we're talking here about public laws. So I ask you, doesn't everyone have a right to know how their economic behavior will be taxed? If I know how, say, the home office deduction works, shouldn't my neighbor have the same right to find out? If Coca-Cola knows how Section 482 of the Internal Revenue Code is going to be applied to their foreign affiliates, shouldn't Pepsi also have the same right to know? I guess you could say this is an example of horizontal equity. And you're at risk of losing that when people start to be excluded from things. Separate incident. A few months ago, a leading university tried to prevent one of our Tax Notes reporters from covering an event where both an IRS and a Treasury Department official were speaking. Now, the reporter was eventually allowed in to cover those panels, but only after an extended screaming match. And we have some very good screamers at Tax Analysts. You don't want to be excluding us from events where the IRS and Treasury people are going to be speaking. What policy considerations would justify the exclusion of the media? Again, we were informed that the presence of our reporter would have a chilling effect on the comments of the government officials that they might make about these sensitive areas of tax law. Well, you see, I'm harping on one point here. So if there's a theme I'd like you to take away, it's that anytime you have a sensitive detail of tax enforcement or tax administration, that does not justify the exclusion of the media. Nobody should get a free pass on press freedoms just because something happens to be controversial. Quite the contrary. I would suggest to you that the more sensitive the subject matter, the greater the case for transparency, the greater the need for openness, and the stronger the desirability of having public officials having their comments memorialized. When the founder of our organization said that secret law is an abomination, he wasn't just talking about the bits of the tax code that were mundane. No, we were talking about the whole enchilada, the whole body of public law and regulation. Another nasty little trick that we sometimes see being played on us is the idea of trading media access for financial sponsorship, which is a sort of an interesting monetary spin on the right to be informed. This has happened all too often. We've seen instances of some industry groups hosting an event, and they've invited a public tax official to be one of the speakers. We approached them a few weeks in advance to make details about how to obtain the press passes and so forth, and their reply is that they would be perfectly happy to have the tax press there, only on the condition that our organization financially sponsor the event. In other words, we write a check for $5,000 or $10,000 to absorb the costs of their overhead or whatever, and we can have a reporter sitting there. We're told things like, hey, somebody has to pay for the coffee break, it may as well be you. Yeah, I don't know about that. I'm very uncomfortable with that. I should clarify that Tax Analysts does sponsor certain events. In fact, we were delighted and very eager to sponsor this event, but that is a voluntary choice that someone chooses to do, in our case, when we think it suits our nonprofit mission. But no media outlet should be forced to sponsor an event for the sake of obtaining press access. I just think that's unacceptable. As a caveat to this, I should acknowledge that the IRS and Treasury are generally very respectful of the role of the press. In fact, it's come to our attention numerous times recently that IRS officials have actually declined, upon being invited to participate in an event, they have declined to participate when learning that the event was closed to the media, which then in turn gets a response from the media organizer. They're very desperate to have the government speakers there, and a deal ends up getting made that, okay, if you want someone from IRS and Treasury, you're going to have to let the press in. That is, by the way, I think that should be handled. I think that's the right answer. We recently had a case where there was an event that we didn't even know about. We have sort of an elaborate calendar system where we track tax events that are going on. And we like to think that we have all of them on our calendar. Well, there was one that slipped through the cracks. And we didn't know about it. We had not obtained any press passes. And someone from the IRS Media Relations Office contacted us to let us know about it and say, hey, they're going to discuss some sensitive things here. We think you ought to be there. So kudos to them for having the integrity to maintain that policy. I wish more government officials would take the same approach that we're seeing displayed by some people from IRS and Treasury, especially our friends up on Capitol Hill. The tax writing committees, Ways and Means, Senate Finance, JCT. It seems that some of those folks have a greater willingness to indulge private audiences. Who knows, maybe that has something to do with fundraising. You be the judge of that. Let me give you another example of an organization that I think gets it right, referring to this balance between reasonable expectations of privacy and the need for transparency, and that's the Tax Executive Institute. For many years, TEI has been hosting forums for their membership, and during those events, they may wish to discuss things amongst themselves, things that are coming up on audit or things that are problematic on returns or litigation. And they may want to say things that they don't necessarily want broadcast across the airwaves or being slapped on the cover of tax notes. That is not necessarily problematic. Let me convey a little story. When I first started my career with Tax Analysts, this goes back to the late 90s, I was summoned off by one of my editors to go attend this TEI conference here in Washington, where a senior Treasury official was the keynote speaker. Trying to impress my bosses, I wanted to do a very good job. I thought I'd show up early, about 20 minutes or so before the program was going to start, or before the keynote speech was going to start. So I checked in at the registration table. That all went fine. And I thought I would open the doors to the conference room to go in and sort of reserve a spot where I could spread out my notepad and be prepared to, apply myself to the task I was assigned with. And it was at that point, just when I was going to open the door, that I was tapped on the shoulder, very politely, by a representative from TEI who said that because there was no government speaker in the panel that was currently going on, I had to wait. So we waited for that panel to end. There was a brief momentary pause. I, along with several other members of the tax press, were then welcomed in, sat at a table in the front row, did what we needed to do, listened to the comments of the Treasury official, and then, once that keynote address was over, there was another momentary pause, and we were sort of politely asked to leave. Now, I really wanted to stay, because I couldn't, talking about check-the-box regulations and all of this stuff. A very exciting time. I desperately, desperately wanted to stay, but I got it. You know, I'm with the tax press. That's a government official. I have a right to be here. And when it's done, then there's a balance. The membership of TEI have a reasonable expectation to speak amongst themselves. So I had no problem with that. I thought that protocol worked very smoothly. Is it secretive? Well, yes, it was, but that is the prerogative of the event organizers and their members. So no complaints from the tax press. However, the instant you invite a public official to get up behind the podium and speak into a microphone, then I say, game on, you've crossed some sort of a line. It ceased at that point to be a private event. Now, the occurrences that I've spoken of, they're not necessarily new. Some among us might recall some of what I refer to as the dark days of the past, where there were sort of institutionalized secrecy surrounding some events. And perhaps the best reflection of that was the infamous Eagle Lodge affair. Hands up, anybody remember the Eagle Lodge affair? Yes, it goes back to the 1980s. A lot of the folks here that are younger probably weren't even in the tax profession when this was going on. But what it was referring to was an annual tax symposium held in a mountain lodge somewhere in eastern Pennsylvania. I guess it wasn't too far from Valley Forge. And it was coordinated, not by the government, but by a leading university that had a highly regarded graduate tax program. And really the key feature of the event was that dozens of key government tax officials participated in it every year, as did a selection of private practitioners. But attendance was by invitation only. So not only was the media 100% banned from the tax symposiums at Eagle Lodge, but the vast majority of tax professionals were as well. This was described as sort of the inner circle of elites within the tax profession. You had to be on the right person's Rolodex to get past the bouncers at the door. Although scores of federal tax officials participated in those events, their speeches, their prepared remarks, their slides, none of that was subject to FOIA because they were cleverly kept out of any agency record. So it truly was sort of an exercise in secrecy. This went on for a decade or so, and nobody but the few well-connected souls in attendance knew what these senior government officials were saying about how the country's public tax laws were going to be applied. The whole thing kind of reminds you of that movie Fight Club. What was the line? The first rule of Fight Club is what? You don't talk about Fight Club. Just so that we're all clear, that should not be the motto for your national revenue body. Well, we've come a long way since Eagle Lodge, and I sincerely hope we don't regress. How am I doing on time? I think I'm doing all right. We'll go through the rest of this pretty quickly. I mentioned earlier on another trend that's disturbing me, and this one is best summarized as the government hiding the ball. And by government, I mean, in this context, state governments, as opposed to the federal government. And by the ball, I mean written guidance or judicial determinations to which taxpayers should have access to. I'm guessing most of the dialogue here over the next 2 days will focus on things that happen at the federal level, but I'd like to take an audible here and expand the concept and think of those 10 articles on the U.S. Taxpayer Bill of Rights. It's one thing as to whether the federal tax system is honoring those rights. It's a whole nother kettle of fish as to whether the 50 states, which all have their own tax administration systems, whether they're doing a good job. So let's look at that. I like to think that every single one of those 10 rights should apply to all state actors, not just the federal government, especially for right number one, which I keep harping on, the right to be informed. So it's worth taking inventory to see how the states are doing in terms of transparency. Some of the folks that I have the pleasure of working with, the tax analysts, day in and day out, especially Kara Griffith and Jennifer Carr, have been relentless in their pursuit of these issues. And the consensus seems to be that the states are often doing much worse at honoring taxpayer rights than the federal government. And there's one example of that I can go over. There are numerous examples we could go over. For the sake of keeping my comments brief, I'll just touch on one here. It concerns the Rocky Mountain state, Colorado. The Colorado Court of Appeals issues around 2,000 written opinions each year, and about 80% of them are designated as unpublished. That means they're generally available only to the parties in the case. And many other states similarly distinguish between published and unpublished opinions. These days, really, unpublished opinions can be published regardless, so it's almost a misnomer. But what's unique about Colorado is that they have a specific policy prohibiting the citation and distribution of unpublished opinions. In other words, they specifically don't want the public to know about them, even though this is 80% of the opinions that the court issues over the course of the year. Couple things I don't like about that. I don't like the idea of a state actor telling a private attorney what they can and cannot cite in the course of zealously representing their client. What if an unpublished opinion is directly on point and counsel wants to reference it in an oral argument or a brief? Well, okay, it might not be binding legal authority, but certainly the concept may still resonate with the trier of fact or the trier of law. I guess in this case it would really be the trier of law. Surely they have competent judges in the state of Colorado, and they're able to distinguish from the bench between persuasive and unpersuasive legal authority. So let the judges do their job. That would be a far better approach than what Colorado actually does and say you cannot cite to those cases. Also, there should be no restrictions on the publication of such opinions. What's Colorado thinking? I don't like the optics of the state telling the media, and maybe this is self-serving because I work for the Tax Press, but I don't like the idea of them saying, don't publish that court decision. These are public courts. This is not some star chamber from the 13th century. We have the Magna Carta here, right? Maybe we should make a copy of it and send it to the folks in Colorado. The free and unfettered discussion on the operation of the judicial system goes to the very core of the First Amendment and Article 1 of the Taxpayer Bill of Rights. That the Colorado courts would seek to shield from public view the vast majority, 80% of the opinions they issue, is appalling. That sounds like, to quote my friend Kara Griffith, the pinnacle of secret law. Interestingly, we actually requested one of these from the Colorado Court of Appeals a while back, and they sent it to us, but it came with a warning. It said, citation was strictly forbidden. Okay, so we're not going to cite to it. And they also said the document was provided, quote, for private use and not to be included in an electronic database or otherwise published, unquote. Well, oops. Nothing like that is going to intimidate tax analysts. We went ahead and published it anyways. So if anyone is here from Colorado and they want to litigate this, we've been to court before. When it comes to inappropriate restrictions on taxpayers' rights to be informed, that is always a battle that is worth fighting. In closing now, the overarching concept here can really be summed up in one word: trust. Our nation's tax infrastructure is premised on self-assessment and voluntary compliance. Although Joe might question how voluntary it really is. It's a bit coercive, but at least we can agree that it's a self-assessment system, and you need trust for that. What do I mean when I say trust? Trust that procedural and substantive rules that are being applied to you will also be applied to the other guy. Trust that you're not a chump if you declare all your taxable income and play by the rules. Trust that the National Revenue Body is not cutting sweetheart deals, otherwise known as Cosy tax arrangements, with other taxpayers, but not with you. Trust in tax administration really should be a cultural norm, and don't for a minute discount the role of culture here. I should note that Allison's blog, which is really remarkable, if you ever get a chance, you should look it up. It's titled Tax, Society, and Culture. Culture is key, I think. Stop and ask, why does the U.S. enjoy such high compliance rates? When I read through Nina's mid-year report to Congress, there was a statement in there that more than 98% of all revenues collected by the IRS, 98% are paid voluntarily and timely, and less than 2% are collected through enforcement actions. That's extraordinary when you think about it. I suspect most other sovereign nations around the world would stand in envy of those statistics. But why does the American public, or at least 98% of them, choose to play by the rules? The main reason is this issue of trust that is embedded in our culture. You know, social pundits sometimes talk about the future of American society, that it's going to be characterized by two contrasting classes of citizenship: the information haves and the information have-nots. Some of these sociologists foresee a bleak future in which this status, access to information, largely determines the outcomes for a variety of human endeavor. Could your access to information, for example, influence whether you get an education, whether you get employment opportunities, whether you get consumer credit, whether you vote, perhaps even whether you get access to health care? If these sociologists are correct, the information haves will clearly enjoy a leg up on everyone else. The other group, the have-nots, are at risk of being marginalized at every turn. And frankly, that resembles a quasi-caste system premised on one attribute: access to information. I often try to translate that paradigm to our tax system, and I don't like the implications when I do. I remind myself that, oh, it's just a hypothetical exercise, but then I read about the 8.8 million courtesy disconnects that took place this past filing season, and there was nothing hypothetical about that. That episode is typically viewed as a taxpayer service problem. What I would suggest is that it also reflects an information deficit and a fairness deficit. And the way to fix that is for everyone to take taxpayer rights more seriously. And we're wrapping up now. So with that, thank you for your attention, and I'll turn it back to David. Was that nudging?
Thank you, Robert.
Was that nudging?
Pardon?
Was that nudging?
I don't know. Was that nudging?
No, that was informal.
I want to remind the audience, those of you who are not from the U.S., that in Colorado, Bob was referencing marijuana is legal. In case you're traveling around the country on vacation, we have time. We have time for one or two questions. Right here, sir. Right here. Yep.
Bruce. Yes, my name is Bruce Segaris, practitioner here in Washington.
Oh, Bruce.
One question is, what about the role of the tax press with respect to their recent investigative reporting of, for instance, the tax deals in places like Luxembourg, and the fact that as a result, in response, governments have prosecuted those reporters. And this also takes into consideration the important role of the consortium, the International Consortium of Investigative Reporters. Anybody have a response to that?
My response is that there's an element of balance between respecting the confidentiality of tax return information. I'm very uncomfortable with the idea that somebody's tax return information is going to be released. Being a zealot, if you will, for press freedoms is not inconsistent with reasonable taxpayer concerns. As far as arresting journalists, don't like it. I think that just leads to bad things. I'm sure somewhere there's a historian here. Oh, Joe, who could probably tell us what happens to a culture when they start putting journalists behind bars for telling the truth.
Yes, sir.
My name is E. Martin Davidoff. I'm a CPA. I'm a tax attorney. I'm not a journalist. I serve as a volunteer from time to time for the NFIB Young Entrepreneur Foundation, and I interview students who are running businesses. And as a tax attorney, I gravitate to saying, so how did you report the sales tax on those sales of 10,000 widgets that you did so nicely? And these are the best and brightest young minds in entrepreneurialism. And none of them, in my experience, my anecdotal experience, none of them know anything about what they're supposed to do for taxes. So the question comes to all of you for the right to be informed, and I'm asking, for Canada, United States, and England, who's represented up there, is there any movement to include tax responsibilities in high school agendas? What I see here is the #1 expenditure for those who are successful in our societies is taxes. And my recollection from high school and the students who work for me is there is not even a 30-minute course on taxes that are required by everybody in the thing. So I'd like to hear your comments, and is there a movement, and if not, which one of you are going to start one?
Can I?
Go ahead.
I'm pleased to be able to say that in the UK, HMRC have just, I think it's HMRC, someone anyway has just put together a package of materials for high school teachers on tax paying with a whole load of exercises and things. And you're absolutely right that it's really important because it's alarming how little people know about their obligations. So we're doing something in the UK.
Allison?
Well, civic education, I pity the high school students that have to sit through that class.
It's fun.
Oh, no, it's not fun. I think the level of financial intelligence is so low that to ask for a level of regulatory intelligence on top of that is, and that's why I really respond to anyone who has ideas. I think Joe, again, to just reference what he said on the last panel, that the way that you make a tax system work is you've got to cut out middlemen and you've got to cut out complexity for the masses. And so you look at Mike Gratz's, 100 million unnecessary returns. It's systemic and it's administrative, finding ways to get compliance to be easier. That's just got to be a key.
Bob, a quick response, because we're going to wrap it up.
Clearly, the solution is to make tax notes required reading for high school.
I want to thank the panel. You guys were terrific. I want to thank Nina again for putting this all on, and I want to thank all of you for participating. Thank you.
Thanks.